World, YouTube, I'm trying out this live. I've never tried out this live, so forgive me. I just wanted to hop on here. I was going to make a video about this. I just shared this on my Instagram. We're talking about spinouts after a merger. Who am I? My name is Nicholas Coriano. Went to business school, went to law school, worked on Wall Street, and now I'm an entrepreneur. I have a real estate holding company, an investor relations company, a ton of online businesses, and I wanted to talk today about spinouts after a merger. So I went and shopped some real estate today and ran into a situation that I thought my audience could definitely learn from. And it's basically, I went and saw this property. The property is being sold by a major media company. The media company has just merged with another public company. And I'm going to avoid names here because you should have been following me on Insta story because I told you guys the names there. But really, I just don't want to put it out there like that. So, but the process is the same. You guys are going to learn about how to get in the middle of a really, really, really big transaction. I'm talking about 8-9-figure transactions and how some of these things work. So let's talk about it. What is a spin out? A spin out is when a company has assets and it spins out those assets or revenue streams, and it spins out those assets and revenue streams into another company. That's the basics. That's the basics of what a spin out is. Now, a merger, because I put that in the title and it's pertinent to this conversation. So a merger is when two companies get together, right? There's a lot of different kinds of mergers. There's reverse mergers. There's specialty mergers. There's a bunch of different kinds of mergers. They call them different things. But at the end of the day, basically what's happening is two companies are coming together. So now, I'm going to give you guys the example that I just went through because I think it's easiest for you guys to learn from. So what happened here? In this situation, two companies came together. They were media companies and they had all these properties, whether they were newspapers, whether they were magazines, whether they were TV stations, right? That's not as important as what happens after a merger. Why do people merge in the first place? Why do companies merge in the first place? Companies merge because there's synergies. There's synergies hopefully there's synergies. Some companies merge just because they want the revenue streams, and a lot of those don't really last. Some of them do. As really a buyout as opposed to a merger. But they have synergies together. And so that means, let's say they had two offices in LA and two offices in Miami and two offices in Dallas. And they had, 100 people in Dallas and the other company had 100 people in Dallas. Now you put them together and you realize, well, maybe we only need 150 people and maybe we don't need two offices. Maybe we just need one. And that's the situation that happened in this situation, right? I went there and they're basically selling off 80 properties. Now, for the example's sake, I don't know what the price of this property is. The broker didn't tell me. He's going to get back to me and tell me what the price of all these 80 properties are. But for example's sake, let's say it's 300 million, right? And it's probably going to be around there, these properties, right? So if it's 300 million, what that CEO, now remember, this is a public company. So the public company is basically saying, look, we don't need this real estate. Get it off of our books. It's just costing us money. Literally, I walked in that piece of real estate. It was empty, right? What does empty mean when it's a piece of real estate? It means it's costing you money. They're paying taxes on that building. They still got the electric on in that building. Even if they didn't have the electric on, right? The taxes alone means it's costing, means it's a liability, means it's costing them money. So the CEO, rightfully and smartfully so, is saying, get these things off of our books, get them out of here, sell them. Now, a smart CEO, there's a smart CEO and there's a genius CEO. A smart CEO says, sell them, get them off the books. We don't want them there anymore, right? Because they're a liability. Now that's going to take time to sell that. A genius CEO, if you piecemeal it, right? Meaning if you sell them one by one. A genius CEO, but you get cash in. There's cash in. A genius CEO says, sell them all in one shot and give me a chunk of what's left over without the liability. How do you do that? Okay, so what happens in some of these situations is they spin out another public company. What does that mean? That means, let's say there's 500 million in assets in this real estate, or 300 million. You've now met the criteria of amount of assets you need to have to be on a public stock exchange, on a bigger public stock exchange, because there's levels to stock exchanges and exchanges, right? So you have the OTC markets and the penny stocks and the pink sheets. I should say the pink sheets, not the penny stocks, right? The pink sheets, the penny stocks, OTC markets, OTCQB, OTCQX, and those tiers where there's no reporting standards. It's easier to trade on those things. And you have the NASDAQ and the New York Stock Exchange, the London Stock Exchange, where there are criteria. So let's say you meet the criteria for the New York Stock Exchange, having 200 million in assets. I think that's the last time I checked, 250. I'll call it 300 million to be safe. you can now list that company. Most companies that list on a stock exchange list for a multiple of what they're worth, right? So if you have 100 million in assets, when you trade on the stock exchange at $1 a share and you have 100 million shares, that's almost never happens, right? Unless you're in a recession or the economy is going down. Usually you're trading at a multiple of your assets or of your revenues. So if you have 500 million in real estate, your public company will probably trade at $1 billion or 1.5 billion or 2 billion, 3 billion, 4 billion, right? Some kind of multiple of that real estate. So the genius CEO, what he says is, look, let's bundle all this property up, put it under its own corporation, and take that corporation public. Now, what happens there? Let's say you have $300 million in real estate, you list on a stock exchange. To be conservative, you get a 3x valuation. That means now you're worth $900 million, okay? The CEO of that former public company can keep a third of that company, which is now 300 million, more than he was going to get if he sold it cash, right? Or keep half of it, call it 450 million, more than he would get if he's going to keep it cash, and sell the other half to investors or the CEO, the guy who put together the deal, and keep 10%, right? Some of the other players involved in the deal can keep another 10%. You bring another bunch of investors in for, the other 30%, and all of a sudden you have a whole brand new real estate company that's separate from the media company. And by the way, that's why they want to sell the real estate. Some of the real estate, they're going to do a leaseback agreement. A leaseback agreement basically means they sell it, but they're going to lease it back from whoever they sell it to, which is great, which means when you're buying that $300 million in real estate or you're creating a new company, right, and the spin out, you now have a company that actually makes money, right, that actually generates revenue. So basically, that's the idea. That's a general idea. I mean, there's a lot of complexities with this. You're not doing this out of your basement without a lot of great people involved. So you're going to need a lawyer. You're going to need a team of lawyers. You need a team of accountants, right? And you're going to probably get a big four firm to be an accountant here because you're talking about building a public company, right? You're going to get one of the top tier law firms to represent you because you're talking about going public. So there's a lot of paperwork, a lot of intricacies here to be listed on a New York Stock Exchange or NASDAQ size level or London Stock Exchange size level. You're talking about having a good investor relations program. You're talking about having an excellent management team, right? You need the CEO, the CFO, the CMO, the COO to be top notch, right? You're talking about running a public company. And then you're going to need the people involved to actually create the market, the broker dealers, the stock brokers, and those players in the game, as well as the investors that end up being in the open market, right? So that's the idea. Just wanted to give you a little clue about that because it reminded me when I was talking to this guy. I said, oh man, this is a perfect candidate for a spin out. See if you can get the CEO on the phone for me, and let's see if we can, bundle the whole 80 all together. What's really great about these situations is usually the investor because these things take time and money, right? So when you talk about going public, this is not a cheap event. It's actually a financing event at the end of the day. But you need finance, like very similar to the saying, you need money to make money. I don't think that's true. I like what Grant Cardone says you need courage to make money. But the truth is you do need some capital. You need capital, you need capital to facilitate the transaction of an IPO or spin out into its own public company, which essentially means, you're going to take the other company public, which is an IPO. You need capital for that to hire the accountants and to hire the attorneys. But when you're doing it from a public company, hopefully they finance it, right? Or they have the financing in line to do it because they understand that at the end of the day, that event will mean that they create, this whole liquidity at a multiple of what they would have got cash. That's the whole point. If not, they can just wait the time and sell it for cash, right? Or find a private buyer for cash, which is also optimal situation. But this is one option on how to get rid of that many assets when you're in a public company situation. So hope this was helpful. Like I said, I was just trying live, so I wanted to see how it worked, and hopefully it works, and hopefully I can share this with you guys. So if you learned something, share the video, comment underneath if you think I can help you guys in any way, or if it helped in any way, or if you have any other questions or any experiences in this field, and subscribe to the channel if you guys think I provide value. And if not, comment underneath and tell me why, because I definitely love the feedback, man. Hope you guys are rocking, stay motivated. Again, my name is Nicholas Coriano. Check me out at nicholascoriano.com. Check out my investor relations businesses at Cervitude, CERVITUDE. I'm going to the gym. I'll see you guys later.